Happy Saturday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Now, I said I was going to take the weekend off, but there has been so much to cover that I'm putting out this episode today, and there'll be an episode tomorrow as well, so that we're on top of very serious and consequential updates before we move into the new week. There's a lot to cover, so let's jump in. And today we need to begin in Asia. Myanmar was hit by a 7.7 magnitude earthquake on Friday, the most powerful tremor to strike the country in a century. The quake triggered widespread destruction, claiming over 800 lives and injuring more than 2,000 people. Neighboring countries, including Thailand and Vietnam, also experienced strong tremors, leading to evacuations and structural damage. Myanmar's State Administration Council reported that 68 people remain missing, while bridges, hospitals, and residential buildings have collapsed. In Mandalay, Myanmar's second largest city, at least 20 fatalities and 200 injuries were recorded. The damage extends to the capital too, where significant infrastructure destruction has been reported. The junta-led government has declared a state of emergency in several regions, appealing for international assistance. European Commission President Ursula von der Leyen expressed readiness to provide aid, while India's Prime Minister Modi also pledged support. Tin prices surged nearly 4% in response to the crisis, as Myanmar is a key global producer of the metal. In Thailand, Bangkok suffered significant damage as a 30-story under-construction building collapsed, trapping over 80 people. 10 people have been confirmed dead, with 16 injured and 101 still missing across multiple sites. The governor announced emergency measures, including a citywide safety audit of government and public buildings. Thai Prime Minister Shinawatra classified the earthquake as a Level 3 disaster, mobilizing rescue and relief efforts. Authorities have set up 11 temporary shelters for displaced individuals and suspended several metro and rail services to conduct safety inspections. Despite the destruction, key industrial operations, including those of Samsung Electronics, reported no significant disruptions. In Vietnam, hundreds evacuated high-rise buildings in Hanoi, with reports of minor structural damage, particularly in Ho Chi Minh City. Despite the tremors, the Vietnamese government stated that no severe damage had occurred. Thailand's financial markets also reacted to the disaster, with the Thai currency, the baht, weakening 0.4% against the dollar. The stock exchange of Thailand temporarily halted trading due to evacuations, with operations expected to resume on Tuesday. As of Saturday morning, 77 aftershocks have been recorded, though most were not strongly felt in Thailand. Emergency responders in Bangkok are continuing efforts to rescue those trapped under rubble, with authorities warning that aftershocks could cause further damage. With communications infrastructure partially disrupted and thousands seeking shelter, both Myanmar and Thailand are bracing for continued challenges in the wake of this devastating earthquake. Next up, we move to North America. Wall Street bonuses surged to an all-time high in 2024, with the total payout pool reaching a record $47.5 billion, according to the New York State Comptroller Thomas DiNapoli. The average annual bonus jumped by 31.5% to $244,700, marking the first significant increase since the COVID-19 pandemic. The surge in bonuses was fueled by a boom in trading and underwriting revenues, nearly doubling industry profits. Quote, "This financial market strength is good news for New York's economy and our fiscal position," end quote, DiNapoli said, though he warned of potential economic uncertainty in 2025. Wall Street remains a key pillar of New York's finances, contributing 19% to the state's tax revenue between 2023 and 2024. The bonuses are expected to generate $600 million more in state income tax revenue and $275 million more for New York City. Despite the windfall, budget challenges loom, including cuts to federal funding and threats to New York's congestion pricing plan. Meanwhile, Wall Street employment has hit a 30-year high, with financial firms leading the return-to-office movement and driving new commercial leasing. However, New York's share of national securities jobs has fallen to 18% from 33% in 1990 as firms shift jobs elsewhere to cut costs. As we will see in tomorrow's video, while 2024 was a good year for Wall Street, this year it has been a much more turbulent time. If you want to be on top of the most up-to-date analysis on global financial markets and economic updates, consider subscribing to Market Update, and you will be. And if you're enjoying today's episode of Market Update, don't forget to hit the like button. Thank you so much. And finally for today, European industries are undergoing a significant transformation as companies across sectors pivot towards defence to capitalise on soaring military expenditures. UK-based The Financial Times reports, for example, InRide, a Swedish autonomous trucking startup, is among those looking to integrate their technologies into military applications, signalling a broader shift in Europe's industrial landscape. InRide, primarily focused on logistics automation, is in discussions with unnamed defence agencies to adapt its autonomous driving systems for military transport. The company's move exemplifies how firms initially developed for civilian markets are finding new opportunities in defence, a sector experiencing unprecedented growth due to increased European military budgets. This shift is not unique to technology firms. Traditional automakers grappling with weak demand and high costs associated with electrification are exploring defense as a potential lifeline. German defense giant Rheinmetall is already absorbing workers from struggling automotive suppliers like Continental, and is considering taking over a Volkswagen plant. As Europe reevaluates its security strategy, asset managers are racing to establish exchange-traded funds, ETFs, focused on the defense sector. Amundi, Europe's largest asset manager, plans to launch a defense-linked ETF by summer of 2025, while US-based VanEck is exploring a similar investment vehicle. These funds reflect growing investor interest, with Wisdom Tree's European Defence ETF already attracting $575 million since its recent launch. The Stock Europe Total Market Aerospace and Defence Index has surged by 34% this year, outpacing the broader Stocks Europe 600. This rally has prompted some pension funds to reconsider previous ethical exclusions on defence investments. The Danish pension fund and Dutch asset manager APG, for example, are among those debating policy revisions, recognising the sector's role in European security. Despite the optimism, some industrialists remain sceptical. John Elkann, chairman of Stellantis, argues that European companies should not abandon their core automotive businesses for defence. Others caution that while military spending is increasing, transitioning into defence manufacturing is complex, requiring regulatory approvals and long lead times. Nevertheless, with geopolitical tensions escalating and European governments prioritising defence autonomy, companies and investors alike are positioning themselves for what could be one of the most significant industrial shifts in decades. Okay, that is today's episode of Market Update. Thank you very much, everybody, for watching. Have a good Saturday, have a restful weekend, and there will be another special episode tomorrow, so I hope to see you all tomorrow.